I'm a farm policy manager with the Illinois Soybean Association. Today we have two really good experts in these fields. We have Dr. Gary Schnitkey. Dr. Schnitkey is a professor in the Department of Agricultural and Consumer Economics at the University of Illinois at Urbana-Champaign. He got his BS in agricultural finance from the Ohio State University and received his MS and PhD on agricultural economics from the University of Illinois. Dr. Schnitkey's research focuses is on farm management. We also have Dr. Nick Paulson. Dr. Paulson is the Gardner Hinderlitter Professor in Farm Management and Associate Head in the Department of Agricultural and Consumer Economics at the University of Illinois. Dr. Paulson received his MS and PhD in economics from Iowa State and focuses his research on risk management and farm finance. With that, I will hand it over to you guys.
Great. Thanks. Thanks for the introduction. I'm going to go ahead and share here. All right. So looks like we got our slides up. So yeah, Gary and I are going to kind of be tag teaming the presentation. I'm going to take us through the first half and provide a little bit of a backdrop and a income outlook for kind of the Midwest and row crop agriculture, maybe a little more broadly. And then Gary's going to lead the second half where we get into some of the strategies that we think are important to think about in low return environments like this for that long-term success objective. So I'm going to start off with talking a little bit about the income side, put it together piece by piece, talk about the revenue components, yields and prices, and then we'll talk about production costs and kind of bring it all together and talk about sort of where we're thinking expectations, where our expectations are, or we suggest your expectations maybe should be in terms of maybe the medium term price outlook and things like that. So, there is going to be quite a bit of not so great news. That's sort of been the theme of our presentations on this topic in the last 6 to 12 months. And so we try to start out with maybe the optimistic or positive side, at least in the Illinois context, and that has been crop yields. And so there's been a lot of concern, I think, voiced about whether it's climate, weather variability changing. That may, or just, lack of continued technological innovation that's sort of keeping that trend yield pace up to keep our yields increasing at the same rate that we've seen in the last few decades. And there could be some evidence of that at the national level, although we would argue that a lot of that is because we're seeing crop production, particularly for crops like corn and soybeans, expand into some areas that are just going to naturally have lower yields, and they tend to drag down that U.S. national yield average. So what might look like below trend or just below trend yields in the last 10 years in the U.S., I think a lot of that is those acreage shifts and not so much concerns about fall offs in some of those technological advancements that have been driving that trend yield growth. Because when we look at a state like Illinois, we've basically been on a 10-year run now. The one exception here is 2019, where we were just below trend for average soybean yield in the state of Illinois. 9 out of the last 10 years, with the exception of that 2019 year, we've been above trend, and we had some years that were well above trend in kind of that run from in the 5 or 6 years following the drought of 2012. If we looked at this picture for corn, it would tell a very similar story. Again, a run of about 10 years, 9 out of the last 10 years with above trend yields. Now, what does that mean for 2025 or even further in the future? Does it mean we are going to continue on that above trend yield run? I don't think we can say that, but I also don't think it means we're necessarily due for a negative yield outcome. We view kind of yields year to year as being just kind of random draws based on the growing conditions that we get. But again, strong yield performance over the last decade for both soybeans and corn in the state of Illinois, and there are years when we've had low prices during that decade where those extra bushels have definitely helped, and then we've had some years with some great prices where those extra few bushels, maybe from what we expected when we planted in the spring, helped even more. So again, that's sort of been the positive side from a revenue perspective. The bad news sort of starts when we shift to talking about prices. And so we've got soybeans here is in green, and then we've also got wheat and corn. This is the national marketing year average price for these crops going back to the 2019-2020 marketing years. This is the national average cash price, or the estimate of the national average cash price received by all farmers growing these crops and marketing these crops during these marketing years. And it's the prices that are used to set guarantees, benchmarks, and determine payments for programs like PLC and Arc County. Obviously, not everybody is the same. Not everybody receives these averages. Every individual farm probably received their own average price that differs from these. But we can see the trend upward from 19 to the peak, the recent peak in 2022 in terms of the prices that we've had. And since that 2022-23 marketing year, we've seen prices kind of steadily declining down. So, we were basically in a 2-year period prior to 2022, where the best time to market was always tomorrow. And now we've been in kind of a similar length period where it's the opposite. The best time to sell has kind of consistently been yesterday. We have seen some rallies in the markets kind of in recent months, more so on corn than for soybeans. Soybeans have kind of continued to stabilize at the low levels we're looking at. So, USDA's forecast for that 2024 marketing year that we're currently in the midst of, looking at a low $10 range price for beans, mid fives for wheat, and right around that $4.35 price for corn. And we would sort of expect those based on futures markets to kind of be similar levels for the 2025 marketing year as we think about maybe planning and marketing plans for that crop that we're going to get in the ground here in the next couple of months. Again, those prices are not historically low. They're just low relative, unfortunately, to where our cost structures have gotten to because of the rising and high prices we experienced from 2020 to 2021 and particularly in 2022. So this is sort of a reminder slide that we like to share that sort of, it sets up my next slide where we talk about, what should we be thinking about maybe in terms of a longer term, 2025 and beyond planning price for corn and beans. Since 2006, which is the period where we would argue we sort of entered a new price plateau because of the ethanol market for corn demand, and then improved demand for soybeans, more so on the international market side, particularly with exports to China. We saw kind of a fundamental shift in the market to new plateau levels. And we varied around that, maybe mid $4 range for corn since then, and sort of the mid to upper $10 range for beans. And we've experienced multiple multi-year periods with prices above those longer on average. And we've experienced and are currently in multi-year eras potentially where we're at prices below those levels. So again, 435, 1010, low $4, low $10 range feels low because of our cost structure. But again, we would probably argue that that's probably kind of it's not out of the realm of where we'd expect prices to be.
The other thing I would point out about this graph, if you look at the periods where we are above it, 2012, in that whole period, we were above it because of a supply issue, 2012 being the drought here. And then a couple of years before that, we had poorer yields in South America and very poor yields in the former Soviet Union. So that caused or was a large part of that increase. And then when that went away, we got below our plateau and then go to 2022. And a number of things caused that, but they were supply issues. The Ukraine-Russia affair, war. We had poorer yields in Argentina and southern Brazil. And so those things did push those prices higher. And now we're sort of back. So there's where we are.
Yeah, and as we'll probably point out multiple times here this morning, it's really hard to predict when some of those supply issues or other events might occur that could push us back up to prices that are above maybe those longer term plateau or planning price levels. So, just to emphasize it again, we would expect that over time, on average, those marking year average prices for corn and beans would be in that 440 to 440 range for corn, 1050 range for soybeans. Maybe one can make the argument that we would see higher prices than that gradually, just because of inflationary effects. And the periods where we will experience some of those high income periods because of higher prices are just really really hard to predict. The other point that I think one of our colleagues who works more in the marketing space, Joe Jansen, has made recently is that because South America has emerged as a much bigger competitor to the U.S. in terms of production levels and their place in global trade, even crop failures in the U.S. might not be expected to have the same kind of effect on price levels as they would 10 or 20 years ago. Brazil has got the acreage and the ability, given their southern hemisphere growing seasons and ability to grow multiple crops a year, that unfortunately, maybe for U.S. farmers, they can respond to crop failures pretty quickly here in the U.S. and that does take away some of that upside that sort of helps to offset some of those yield losses when they do occur. It's a good kind of segue into maybe again pointing out some of the points here that we would make that would be relatively pessimistic in terms of looking ahead and trying to identify things where you might argue that we'd get another plateau change, a positive one anyway. The expansion of acreage in Brazil, which we've got a slide here coming up, the next one that kind of highlights that. But again, the U.S. is sort of, has become a relatively smaller piece of the overall global soybean and corn trade because of the emergence and growth in production in places like South America, particularly in Brazil. Some other headwinds that we see here is that, population continues to grow. It's projected to grow, until maybe 2050-ish, depending on which projection models you're looking at globally. But those growth rates are slowing down and even, becoming definitely flattening or even becoming negative in more developed parts of the world. And so, that sort of slows down that kind of natural demand growth factor that we might see from population increases. Doesn't stop it, but it slows it down. And then there's ongoing concerns about, how much can we rely on continued growth in meat consumption in the developed world. Typically, when we see rising incomes, we see increased meat demand, which helps supports grain and oilseed markets on the feed side. But there's arguably some slowing growth expected in that component moving forward. And then, finding the next China in terms of a really high growth potential export market. There's not obvious clear-cut candidates for who the next China might be. And then, maybe have some time for some questions and we can try to answer them on biofuels later. But, for now, I think there's just, whether it's you look at the new administration and sort of how they might be less supportive of biofuels in general. I think some concerns with, potential for additional biofuel growth in the future, whether that's from the political policy side or just, maybe natural trends towards just slower growth or plateauing in fuel use, which is really kind of key to supporting ethanol demand and biodiesel demand for corn and soybean price supports.
So this happens, both Nick and I were in Brazil. It would have been 2 years ago now.
Almost 2 years ago, yep.
Yeah, so time flies. The numbers on here, and I would point out Mato Grosso, there's 12.65, and that's 12.65 million acres. And that is estimated by Embrapa, which is a Brazilian research sort of like USDA, but not quite. And they estimate that 12.65 million acres in Mato Grosso, for example, are what is known as degraded pastures. Degraded pastures simply mean they haven't put fertilizer on it for a while, and the grass is still there. It might not grow as well as you would like with better fertilization. But the point is that this degraded pasture can be quickly transformed into farmland. And the process is pretty simple. They take a bulldozer with a chain over it, get all the scrub trees off, and then throw a lot of fertilizer and lime on it, which is the costly part of it. But it's easy to convert. And once it's converted, it's going to stay in cropland because it's just like, in some sense, Brazil is doing what the Midwest did in the late 1800s. They're converting prairie land, pasture land to farmland. Well, if you look at those numbers, 12.65, Mato Grosso do Sul, 20.72, add them all up, you have the area of roughly Indiana, Illinois, and Iowa. And so that is the potential of acres to be added. So anytime we sort of have this price spike, you're going to see the process by which those acres get converted. So Brazil is going to continue to grow just from land expansion. So if you think, all right, we're going to get some more biofuels, yep, that's all good, all good, and we're going to get then more acres in Brazil. So
Yeah. Yeah, and I think, yeah, so yeah, I did the math and it's like the three I states combined 40 to 50 million acres that could come on and the question is, well, what happens to their livestock industry? Because it is pasture land. They could graze much more intensively on fewer acres. This pasture land is not used nearly as intensively as you might think some of the pasture land would be used in the US. So
just just so we get the pessimism here in the crowd.
All right. Okay, so that's sort of the revenue side and a little forward looking on, again, maybe some pessimistic outlooks for potential for consistently higher prices, driven by something that might occur in the future. Now we'll talk about the cost side a little bit. These are production costs for a corn soy rotation. We've got non-land costs in orange, and then our land costs. We always use an average cash rent for the region. That's the blue portion here. And the main message here, again, these don't apply to any individual farm. These are averages across multiple farms within a region of the state. The numbers do differ for Northern Illinois, Southern Illinois, but the pattern, the trends, the periods in which costs increase more quickly are very consistent, regardless of what region of the state that we look at. And the key thing to point out here is, when we do experience those higher price driven, high return periods, our production costs, with a 1 to 2 year lag, do tend to adjust pretty quickly to those higher revenue levels. And then it's very hard to get those costs to come down at anywhere close to the same rate or magnitude when we get into periods of lower prices and lower revenues. And so we can see that costs increase pretty rapidly over about a 5-year period during the ethanol boom and export market expansion for soybeans in the late 2000s, early 2010s. And then, came down, adjusted down a bit, but basically plateaued in that lower price period, lower income period we had from around 2014, 2015 through 2020. The big adjustments, again, stand out that we saw for the higher incomes, higher prices in 2020, 21, 2022. You see the cost adjustments kind of follow with about a year lag there, big increases in 2022 and 2023. And, we are expecting, once numbers are finalized for the records we have, to see lower costs for 2024. And we're projecting further cost declines for 2025, but not to the extent that we saw the increases in the years leading up to that.
Yeah, and that is a big thing. If you we hit our high cost in 2014, we did come down, but not to the levels that we were back in 2000 to 2006. We sort of expect the same thing now. We will come down some, but we won't get back to 2016 to 2018 levels. If we do, that would be historically abnormal, maybe, but it could. But what we are projecting is lower costs primarily from fertilizer, nitrogen, P and K, all of them, but nitrogen is the big one here. And we projected a reduction in land rents, which we will see, but we will see.
Yeah, we'll see. That projection and decreasing land costs for 2025, I think we sort of talked about that in August, early fall last year. We're sticking with it, but I think things like the economic assistance payments we saw passed in December, those checks actually hit the mail, or the direct deposit hits the bank account. I think that's going to maybe make it more challenging to get some of those reductions that we would have expected to see. But that's a topic for a whole webinar potentially. So what do those production costs levels sort of imply? And here we did include all the regions and kind of crop budget scenarios that we look at for Illinois. So I'd maybe focus on the break-even prices there on the right. That is the break-even to cover all costs. That is the non-land plus the average cash rent for the region is our measure of land costs that we use there. And we're looking at break-even corn prices in that 460, even getting into the high 460 range in southern Illinois as a break-even for corn production. Again, obviously, we're looking at more like a 430 projection maybe for 2025. So we're about 30 cents below break-even there in a typical cash rent situation. And soybeans, we're looking at more 11 to 1150 break-even prices across Illinois for 2025 to cover all costs. And we're almost $1 below that, or more than $1 below that if we look at the southern Illinois break-even in terms of where we think that those cash prices, marketing opportunities might be for the 2025 soybean crop. So that results in negative returns, particularly on kind of typical cash rent farmland situations. If you own all your land and it's paid for, I guess you can say that you're doing better than break even. There is a positive return there, but economists would argue that you should build in even an opportunity cost for your land, even if you're in a owned land situation where it's paid for. Majority of your own land is paid for. So returns, I mentioned the economic assistance payments, the $10 billion portion of the American Relief Act, a total of $31 billion in that American Relief Act, which the big thing with the American Relief Act is that it continues to fund the federal government through next month. It was a continuing resolution, but there was almost $31 billion allocated in that piece of legislation for agricultural assistance. About 2/3 of that is for disaster assistance that we wouldn't expect to really impact too many Illinois farm situations. That's mainly going to be going to areas that were hit by hurricanes, wildfires.
That might top up the ERP program.
Yeah, we don't know exactly how that natural disaster assistance will be defined, but if recent years provide any precedent, it would probably be something similar to the ERP or WIP programs that we've had in recent years. So yeah, top ups to crop insurance coverage. And then the $10 billion for the economic assistance, these are direct payments. The same amount goes to every farmer across the country by crop. These are estimates, and we've got the corn, soybean, and wheat ones highlighted there in the different colors. So we're estimating about $43. These payment rates haven't been finalized or published by USDA, but based on the formula that they said they will use, about $43 per acre for corn and about $30 per acre for soybeans and wheat. And those payments are outlined to be paid on every acre planted to that crop in 2024 and half of your prevent plant acres allocated to those crops. So, half of your prevent plant corn acres and all your planted corn acres, same thing for soybeans and wheat. Those are supposed to be made by March 21st. The legislation specifically outlined a 90-day window that those payments had to get finalized and out the door. That legislation was passed on December 21st. So, you know, some or a lot of uncertainty right now with government spending, with what's going on in Washington. But based on the law that was passed in December, those are supposed to go out and be received by, well, just prior to planting.
Yep. So, and Nick and I have different opinions about whether those will happen on time, right?
Well, whether it's closer to certainty or closer to a coin flip, that may be where we differ. So I'm less confident that we'll get those by March 21st than I would have been around Christmas.
Yep.
So net farm income. So this is a statewide average. Again, all the numbers we've been showing you are based on actual Illinois farms, cooperating members of the Illinois Farm Business Farm Management Association. So you can see here the pattern is very similar to what we saw for prices, what we saw for the production cost slide. We've had some in the last almost 25 years now on this chart. We've had some excellent income years or eras. And you can see the prior net farm income record was actually set in 2012, despite the drought, largely because of the RP coverage that Illinois producers buy and the guarantee increase that goes along with that insurance coverage. Our yield losses from the drought in 2012 were compensated at much higher prices. And we had nearly $300,000 average net farm income in the state in 2012. And then we approached that in 2020, went above 400,000 in 2021, and just passed the $500,000 net farm income average in 2022. 2023, and then our projections for 2024 and 2025 are back down in that range of farm income levels, and kind of that less than 100,000, less than 50,000 for 24 and 25. More similar income levels to what we experienced in that most recent lower price period from 2014 through 2019. So that's where we're at. This 2024 number does include those economic assistance payments too. So without that, we would be looking at negative average. And then the other two series we've got there are just sort of things that we tend to see are correlated with income levels. So we do tend to see capital purchases increase with higher incomes as farms use that income to reinvest in their operations. That's mainly going to reflect machinery investments. And then we've got our family living expense series there. It's not as obvious, the adjustments that are made to family living, but we do tend to see increases, faster increases during high income periods, and then definitely some budgeting and pulling back on those during low income periods. But a lot of those family living things are tough to significantly adjust, just because some of those things naturally increase with time, and there's only so much household budgeting you can do on that. But we would expect that capital purchase number to be coming down, and that kind of feeds into one of the things Gary's going to talk about here as we move forward.
Yeah, one other thing about this, if you're looking at that 2024 and 2025 have been roughly the same income projection at this point in time. Again, we're putting EA back in 2024 income, so it would be a receivable and then impact income. But if you did that and prepared your financial statements, and you didn't, and whatever happened to net worth and working capital from 23 to 24, you can reasonably say it's going to look about the same in 2025.
Yep.
And if you didn't put EA payments in 2024 and you came out smelling like roses, you're great. You're golden. So
yeah, because if you're using cash accounting, I'm sure you are for tax purposes, but these are accrual based numbers. That's how FBFM sets up their financials with their cooperators. But if you're using cash for your financials personally, your 2024 income may look a little worse, but your 2025 income will have those EA payments in there. So
yeah.
All right.
So all right, now Nick and I are going to talk about strategies, and the first strategy is take advantage of every available government payment. And again, you know, the EA payments when they come out, obviously and the ERP payments, when FSA announces those are going to occur, you might want to make sure that all your information is in order. I know that some individuals, you know, may dislike government payments for whatever reasons, but particularly if you're a young producer, you have to take the cash in this sort of environment. There are
Your peers are gonna cash the check, so.
yeah, so and then you know there's two decisions, risk management decisions that are coming up. The ARC PLC decision. One thing that we note about that is that you have until April 15th this year. So you have till April 15th this year. And basically you can make for each program crop is the important delineator here. It's not what you plant, it's program crop. You can make a PLC ARC county choice for each one of those, and those can differ by FSA farm, or you could enroll them in ARC IC. So and those changes, or those choices, excuse me, are the same as has been the case for the last several years. So PLC ARC County, again, you have till April 15th to make that decision. Yeah, it's the same decision. If you do not change it, you will have the same program as you did last year. Here's the way our economics for this looked like. And actually, we will have a webinar on Monday, March
3rd, this Monday, we'll do a webinar on crop insurance decisions. And then Friday, March 28th. Is the ARC PLC. We're going to focus on the ARC PLC decision at the end of March.
So here's what the choices look like now. For soybeans, ARC County has the highest chance of payments, and actually prices need to be very low for PLC to exceed those of ARC County. So there's a very strong lean to ARC County. And one of the things that you can do to look at that is look at soybeans over on the right. You see the effective reference price is 966. So that's well above the statutory reference price, which is 840. But so the effective reference price has went up because of the escalator. But our county's benchmark price is 1217, and 86% of that ARC price is 1047. So 86% of that's a pretty important number, because that's the ARC County guarantee, ARC IC guarantee as well. Revenue has to be below 86% of the revenue. Well, 86% of the ARC price would trigger a payment if yields are at or below the benchmark yield, and sort of gives you a break even, but between PLC and ARC County. And if you look at it, 1047 is well above 966. So ARC County for soybeans is going to pay in many more situations than it does for PLC. Corn. Again, ARC County has the highest chance of payments, but PLC will pay more at low prices. Whether it's a strong lean or a lean is a good question, but we would tend to lean to ARC County. Again, if you look at 86% of the ARC County price, 433, that's above the effective reference price. Finally, for wheat, same sort of thing, has the highest chance of payment. Think ARC County. Again, there is this caveat in each case is if we get very low PLC prices, our PLC can pay more than ARC County, but there's a lean towards ARC County. One of the other things that this will do is impact whether or not SCO is available.
The crop insurance program.
Which is a crop insurance program. Frankly, I would take I'm not sure I would take SCO in any case. But, 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 our county, particularly for soybeans, and even corn, you look at it and you say, I don't have to pay anything and then get a payment. Why would I pay for an SCO product? And I mean, you might.
Yeah, current situation, I think we're in agreement on that. We wrote about that in a recent Farm Doc Daily article.
So we're strongly leaning towards our county for soybeans and leaning for corn and wheat. So the other decision, again, with relative to government programs is relative to crop insurance. And again, this one is the one that's next week. Most of the farmers in this audience that are listening here will have taken RP at pretty high coverage level. This shows the coverage levels in Illinois. You can see both corn and soybeans are above 80%. And that continues into 2023 and probably 2024. Although the data's not quite all in there, but yeah, it will continue into 2024. Again, and by the way, 80, when it's above 80%, that means that many farmers in particularly central and northern Illinois are buying at 85%. What we see is more farmers in southern Illinois buying at a lower coverage level. But if you're in the, and again, that's the average coverage level. If you're in that position, that's probably, we would not persuade you to be out of that. So stick with RP, probably at a high coverage level, or at a high coverage level. And remember, the RP has that guarantee increase in it. So if we have a drought like 2012 again, the harvest price will likely be above the projected price, and that is the year when that RP product will make higher payments. We're not predicting a drought, so
Just an if.
Just an if. It's a what? 1 in 25-year event, maybe less, maybe a little bit more. It's one of those low chance events that's hard to evaluate the probability. So far, the projected prices for 2025, and we're almost at the end of the period. So for corn, last year it was 466. This year so far it's 472, 2025. We got a couple days left. But unless something wild happens, you're going to be seeing about slightly higher, about the same projected price. We have the volatilities listed there in parentheses. The good thing is that the volatilities are going down, and that has a large impact on premiums. So that lower number for corn and soybeans mean that premiums will be lower. Be less. Those are only based on the last 5 days, so those can change more. Yeah. So we got actually 3 days to go. So
Friday would be the last day of the discovery period.
So soybeans, 1151, and that's going down to 1057. That's what it would be right now. Yeah, it's $1 less roughly for soybeans, matching the economic outlook. So corn is about the same from last year at this point in time. Soybeans will have projected lower returns. Again, most farmers have taken higher coverage levels on our RP on both corn and soybean products. Seems like a good place to be, with the caveat that we have had low loss ratios. Here, just to show you, this is the net insurance payment that farmers received, which is payments minus farmers paid premium. On the left is for corn and the right is for soybeans. So let's pick a county. McLean County, which is the big one, or in the middle of the screen. minus $13 for corn, minus $6 for soybeans. What that means is that for that average from 2014 to 2023, farmers have paid in $6 more for soybeans and $13 more for corn in that county than they received back. So again, that is just a fact of life. Again, those the big payment years tend to be drought years, and there isn't one in any of that 10 periods. So we're looking at very low losses, and farmers are paying more in than they're receiving back on a countywide basis. And you can see the greens are when it's positive, and the reds and reddish ones are when it's negative. That, by the way, is due to low loss ratios. And we would argue, or I would argue, that won't put words in Nick's mouth, that the premiums are relatively high to the payments. So there is that caveat, but still, most farmers in central and northern Illinois take RP for soybeans at 80 and 85%. It's kind of hard not. It's kind of hard to say not to do that. The other thing that you may want to look at this year is the enhanced coverage option, which offers a county level band of coverage from 95 or 90%, you make a choice, to 86%. This year, RMA increased the subsidy level on that, and what that will result is lower premiums. So I gave an example for Macon County corn. Last year, a 95% coverage level ECO product would cost $27. This year, it will cost $17. So that's a substantial savings. You can lower that is at the highest protection level. If you think $17 is still too much, you can lower the protection level. That will lower the premium and lower the payments when they occur. You might want to take a look at this for a couple reasons. The subsidy has gone up on it, and also you aren't required to make a commodity choice. You can choose Art County and use ECO. I think there's a good case to be made to have ECO, relatively high RP coverage level, and not take SCO again. And I would guess that there's likely a stronger case for corn acres than for soybeans. And here, just to give you a feel, if you had done from 2015 to 2023, ECO has not been available in all those years, but we simulated the premiums back. And this is the net payments on those. And you can see there that soybeans for the Midwest states have very, very low numbers. This happens to be under the new 65% premium support rate. So we went back and looked at that for those values. Again, Illinois has a lot of red numbers, and that's something that you got to keep in mind when you're making those decisions. All right, be a low-cost producer. All right, here's what we observed. We got two things here. On the left-hand side of the screen, we see FBFM results from the high minus the low profitability farms over a 10-year period.
So it's like a gap between the farms that performed well relative to their peers versus the farms that performed not so well relative to their peers.
Yeah. And so the thing that we see is that and these are cost savings between those groups. So the high profit groups had $10 lower cost in buildings, $14 lower cost in other, $15 costs, lower cost in labor, and crop costs were $36 lower, which would include fertilizers, seed, pesticides, $36 lower. Power and equipment was $40 lower, and that would be related to machinery related strategies. And land was $41 lower, and that cash rent comes into that play there. Anyway, we see that our high profit farms also tend to be low cost producers. And the other thing that we observed is from another set of data, precision conservation management. The same producers have above university nitrogen rates, have higher pesticide costs, and more tillage practices. And what we observe there is that the university rate is like 180 to 190 pounds of actual N per acre. We see farms that have above that. Profits are maximized at that rate of 180 to 190. So going above that, we lower profits. And what we see is those farmers that have above university nitrogen rates also have higher pesticide costs and also have higher tillage passes. So we see those farms that have those characteristics also having lower returns. And so it just does seem to be so cheap. If you look at all those higher nitrogen rates, higher pesticide costs, more tillage practices, they all have a slight impact on increasing yields. But those yields are coming at a high cost, and we're looking at lower prices now. So those high cost items become more detrimental to returns when we're looking at a lower price environment or an average price environment, depending on your point of view. Number 3 is to reassess land rental strategies. So 1, take advantage, be a low cost producer, reassess land rental strategies. One thing that we note is that farmers that are anticipate being an ongoing operation, 10, 15 years, or a younger producer, they're going to have to increase their land base. And we're going to have a marketing approach. How's this farm going to attract new landowners? A farm resume and a sales pitch. And we again have to think about increasing the land base. But a critical question is going to be how much will or can a farmer pay for cash rent farmland? And here is just overhead that shows average returns to central Illinois land for the average cash rent. And the average cash rent there is given by that figure, or the red line, it's $359 in 2024. So you can see that average cash rent has been going up. The bars, green primarily, and then occasional red in there, are the farmer return from that rented farmland after paying the average cash rent. One thing to note here is that the average farmer return over this entire period is $103. There's a lot of variation in there. I would argue it hasn't changed. $103. And if you go back to the 1990s, and we're in farming then, my guess is you would have been budgeting $90 to $100 return for farmland back in the 90s, and you're doing the same thing today. All right.
With much higher cost.
With much higher cost. And that has a couple of implications. One, it is much harder with a $90 return today and our land prices and cash rents where they're at. It's harder for young producers to use cash rent farmland to make payments on own land, just because our return has remained the same, but our cash rent and our debt servicing costs have gone up. So the strategy of using cash rented farmland to pay for own land is more difficult. The other thing I would point out is the negatives The -93 and the two red bars there have gotten bigger in recent periods. But just to summarize here, we've seen a lot of high cost or high return years, and then some lower return years. And here's a philosophy that I've heard farmers give. That is, we're going to farm for a break even in most years, and then we're waiting for the higher returns in the minority of years. 2007 to 2008 would be the high income years, 2010 to 12, and 2020 to 2022. All right. And again, you look back, that's the period when cash rent farmland had the highest returns. Here's the problem. When will those higher income years happen again? It could be next year, or this year, even if we have a drought, I suppose, or something else happen. At this point,
Ideally, a drought somewhere else.
somewhere else, Iowa would be a good place for a drought. Or it could happen 10 years from now. The second problem is that profits are extremely low now and projected to continue at those levels. So the strategy of holding on has become more costly now than it was even back in 2015, 2016. So this is the question, and I got two, we divided this up into two parts. So what are you going to do with high rent farmland? And here I divide this up into two parts. Established farms with a stable land base. So you got some owned land, some share rent land, some cash rent farmland at reasonable levels, and then some high cash rent farmland. Why are you doing the high cash rent farmland? And I would, just in this case, if this is the case, take a look at those high cash rent farmland. Take it out of your operation and do a cash flow and see what it looks like. And in many cases, the overall profitability may look better without it than with it. All right, younger operators relying on more rented land with a high cash rent. How long can this go on? And just look at that. Do look at that situation. And the other thing that I think younger operators are going to have to think about is develop another source of cash income. And I would think that younger operators may want to think more about this. They still need to think about owning farmland, which is high cash flow requirements. Another income source, another farm business along that lines that generates cash income may be what's needed to build that own land base. And again, just thinking about where we're at now relative to our farm returns, relative to cash rent farmland and the like. Finally, reassess machinery strategies. We're going to only focus on one here, and that's the combine. And here you see our estimates of combine costs with three different combines. And you'll notice that those go down appreciably. This is a new combine, but those reach lower levels when we begin to get up to that 2000 plus area. And if we're looking at combines and the harvesting portion of the farm, over 50% of our equipment costs can be generally associated with harvesting, and the combine is a large part of that. And so really looking at that combine, and if we're thinking about purchasing a new one or a different one, spreading those costs over many acres, more acres really drives down cost. And so machinery sharing and those types of things probably are more important now than they were in the past. And again, just given where combine costs have gone and where we're at right now, thinking about those machinery strategies probably needs to be on the table. So those are our strategies, and we want to thank you for your time today. And while we would say that incomes are lower now than they were a couple years ago, there's reasons to be optimistic about agriculture, and we're sort of in the normal rather than the 2020 to 2022 period likely is less the norm than what we're in right now. So we'll stop there and appreciate any questions. Colin?
We did have a question here from someone, Gary. Let's see, what are the pros and cons of self-insuring my crops? Do I lose out on anything other than a claim? Looks like I would win more often than not insuring. That is true. And Gary, you can add in here, but I think the risk you run there is it's the 1 year.
Yeah.
It's the 1 year that could put the farm business in jeopardy. And if you're in a position where that's not a realistic risk, then I think self-insuring is something Illinois farmers reasonably have to take a look at given historical performance of crop insurance. But it's that 1 year, and I think depending on your situation, the risk associated with that is going to vary, and so that would be the one reminder I would give. Crop insurance is one of those. It's the only insurance product I know of that we use as human beings, where because it's subsidized, we should expect a positive return over time. I don't hope I have a claim on my car insurance to justify the premiums I pay or my health insurance, but crop insurance is one of those because of the subsidies. You look at the numbers in Illinois and you kind of wonder, why am I doing this?
Yeah, I would tend to also look if historical experience says we have less chance of payments on soybeans than corn, so you might be looking at lowering payments or premiums on soybeans rather than corn. I would tend to stay in the program because any disaster payments tend to be tied to your crop insurance level. So you might try and lower the coverage levels if that's something that you're thinking about. And I would also then go back and say, yeah, the minute you lower your coverage levels, particularly if you're in northern and central Illinois, you're significantly lowering.
Got a question about rents we should expect in a specific county in Illinois, specifically Montgomery County. I don't know if we'll be able to answer that off the top of our heads, but Gary's on his laptop and we might be able to share a link to an article that might help sort of answer that question. Is that where you're going, Gary?
Yeah.
If there's another question we can answer while Gary looks that up, we could take one.
Yeah, guys, I'll throw in a question. So with all of this information you've given us today, how does the farm bill, or the lack thereof of farm bill, how does that kind of impact all of this in your opinion?
For 2025, I would sort of make the maybe surprising claim that I honestly don't think it affects all that much. 2026 is probably a different story. The 2018 Farm Bill was extended to cover 2024. It was extended again to cover 2025, also part of that continuing resolution in December. What we're going to be going through in the next year, this budget reconciliation process, and even what was, I believe, passed yesterday in the House, looking at cutting what that called for, based on what I read in the news, is that they're looking at cutting $230 billion out of the Farm Bill baseline, which is a 10-year measure. That's not $230 billion a year. It's $230 billion projected over 10. Not all of that would come out of farm programs, but a lot of it's going to have to, but not all of it probably is going to come out of nutrition assistance. So I think the beyond 2025 is the real question. Given we're in a kind of a budget-driven reconciliation process, though, I think it's going to be more difficult than it was a year ago or even 4 months ago to get a farm bill that significantly beefs up support in any way. And in fact, I would tend to put my money on maybe a stable to even a slightly weaker farm safety net. I don't know,
Yeah,
Gary.
yeah, no, I would agree with that. Again, it would seem like there's cost cutting in the air, so that would be saying um a lower safety net. So, by the way, so if you want average cash rents, go to a September 3rd, 2024 Farm Doc Daily document. And in 2024, the average cash rent in Montgomery County is $322 per acre. And again, there's a map with all the counties given. Obviously, that really depends on the productivity of the farmland. So we see $50 to $100 variation from that average. And I would again be expecting that that's 2024. I would be expecting that to come down, but who knows?
What was the name of that one? I could put the link in the chat, Gary. Is it the setting 2025 cash rents?
Yep, setting 2025 cash rent.
If the attendees can see in the chat, Corey, I'll put the link to that article.
We can send it out after the webinar, but we do have another question. Excuse me. So how are we able to how would a farmer be able to decrease impact on imports or cheap imports?
Might need a clarification on that one. So negative impact on cheap imports from the perspective of, I guess I maybe need a clarification on that one.
Yeah, it's kind of hard to, if we're concerned about tariffs impacting prices, I mean, there's not a lot we can do to protect against, price declines because of tariffs. It does, you can think that with tariffs, farmer or most companies probably need to think more about domestic markets, but it's kind of hard to think about how a farmer would do that without going into something completely different as a crop or a livestock.
Yeah, I mean, we've talked a little bit over the last few months about, commodity producers are sort of, price takers, and we're sort of at the whims of, international markets as well as domestic use. We've also talked about kind of commodity plus systems, whether that's if there's opportunities in your area for food grade, white corn, non-GMO, organic is more of a multi-year process to get into. But, some of those things that are, you are relying on a premium that may go away very quickly, but those would be maybe a little bit sheltered from some of the retaliatory tariffs that could impact some of our prices. In terms of farmer impacts of the tariffs we're applying on other countries, one of the big ones we looked at was maybe on fertilizer inputs, particularly potash coming in from Canada. That would be a concern that could if some of those tariffs materialize and stay in place for any extended period here in the coming months, we'd be looking at higher potassium fertilizer potash costs for the 2026 crop. So
Yeah, and they asked specifically for like Brazil, but I'll kind of expand more on that. And you kind of hit on it too, but I'll expand a little bit more to that. And what are some things that we can do to make our products more competitive against Brazil, Argentina, other competitors?
Yeah, that's a challenge. They do have pretty competitive cost of production. The one advantage that Gary and I saw firsthand is still definitely on the logistics side. But when it comes to the commodity space, it's tough to come up with an answer about that. The strong dollar right now, particularly relative to the Brazilian real, doesn't help. So again, in that commodity corn and bean space, they're going to be a fierce competitor.
Yeah, the one thing that I would say that I think US will have a lasting advantage in is the quality of the soybean, simply because the harvest in Brazil is going to be during a wet period. So emphasizing quality, and that's probably something that has to be done more at a, ISA, US level than even at a farmer level, but quality will be advantage of the US versus Brazil.
They kind of expand more on their question in the Q&A if you guys want to take a look at that. But while we do that, I'll also ask, and then I guess just what are some state or federal policies you guys have seen that our farmers should be focused on or thinking about as those start to come down this year, next year, and kind of into the future?
All no.
No, I mean, the biofuels policy is not necessarily Gary or I's wheelhouse. So you'd agree, right? Our colleague Scott Irwin has done a couple of really good webinars recently that you could find on the FarmDoc site that really did provide a really good outlook for both ethanol in one webinar, and then more on the biodiesel, renewable diesel side in a separate webinar. And everything I've heard Scott say, as a reader and follower of his work, is that those markets, what policy should we follow? Particularly on the biodiesel side, those are such policy-driven markets at this point. Ethanol itself, corn ethanol for motor vehicle use, I think we've sort of seen the benefits from that. I think we have a pretty solid foothold in that market. 10% of the motor fuel we burn in this country, it's the option that the petroleum refiners use now as their octane enhancer. And so that's less policy dependent than maybe the biodiesel space or like the sustainable aviation fuel space. But those are gonna require supportive policies to kind of emerge and grow at rates that would really benefit producers.
You would also, and this is not our area either, but the IEPA and the Endangered Species Act and what that's going to do or attempt to do to pesticide regulations. So that is another area. And so, biofuels, Endangered Species Act. The other one that, and I don't know how this is going to play out, is what the nascent carbon markets and the sustainability efforts. That's going to take a switch as well. And again, it's hard to say what that switch will be. It's probably not going away. And I would not bet on it going away because, this it could swing back and forth depending on what administrations are doing. So that's another bucket, and obviously the farm program, farm bill, and I guess I wouldn't expect any major good news from the farm bill efforts given policy environment right now.
Yeah, I mean the big thing on the farm bill, last year that they were talking about, was trying to improve reference prices for crops. We wrote quite a bit about that. It would have improved things for corn and soybeans. Soybeans is just in one of those situations where even small improvements to the reference price don't provide a lot of meaningful improvement for producers because the reference price is just so low to start. And it's an expensive change because of all this corn and soybean acres. And compare that to some of the other crops that are grown in different parts of the country that already have very favorable reference prices. Even giving them a boost is relatively low cost from a baseline perspective. So it's a tough spot to be in. It's the tough spot that the bigger acre crops like corn and beans have.
Yeah, and all those issues that you hit on are all issues that ISG is working on for our farmers. But as we wrap up, just want to see if you guys have any last thoughts you want to leave for our farmers before we wrap up today.
We're sort of back to the normal. And you know, it is what it is, and we'll all make it through.
Yeah, that, I think by and large, the majority of farms, we look at averages, I know that's an average, and there's some even in better shape, some obviously in worse shape because it's an average, but where we were at, in 23, following those high income years in 2021, 22, we were in excellent financial position to weather a few down years. And it's a cyclical business. If you've been farming any length of time, you've gone through this before, maybe multiple times if you've been farming multiple decades. So we we're gonna continue to plant corn and soybeans in Illinois, I think.
Yeah.
Well, I
And be
want to thank you
successful.
guys. Sorry, I want to thank you guys and thank everyone for joining today. This has been informative and we appreciate it.
Thank
You're
you.
welcome.